Hello and welcome to Educare Coaching Academy. In this video, we will look into the world of balance sheet analysis, a very crucial aspect of financial evaluation for individuals, investors, and all businesses alike. By analyzing a company's balance sheet, we can get valuable insights into its financial health, just like liquidity position, operational efficiency, and the profitability situation also. In this video, we are exploring some of the important financial ratios and what they are telling us about the company's financial conditions. Now let's go to the document and analyze some of the ratios which we can find out from the balance sheet and what they are indicating. Here I have mentioned about 5 important ratios. They are not complete, but we can have a lot more ratios from different variables by analyzing different variables from the balance sheet. But these are some of the important ratios which can be relied upon by anybody who wants to know about, or anybody who wants to analyze about the balance sheet of a particular business organization. So your individual interests, or you as an investor, or you as a business person, it is all helpful to this analysis of various ratios can be helpful to all these different stakeholders. So the stakeholders are getting informed decisions, or they are going to make significant decisions about their actions based on the analysis of these important ratios. So now let us look into these ratios one by one. The first one is quick ratio. Here we can see a formula. Quick ratio is founded by, it is a relation between these two variables like quick assets and current liabilities. So quick assets divided by current liabilities is quick ratio. And here quick assets means it is founded by subtracting inventory from the current assets. So current assets minus inventory is quick asset, and dividing quick assets by current liabilities, we will get quick ratio. And this quick ratio it can be useful in knowing the solvency of a company and how fast they can repay the short-term debts with their quick assets. So quick asset is current assets minus inventory. Current assets involve inventory also, but when we divide inventory from the current assets, we get the quick assets. Quick assets can be converted into cash a little more faster than inventory. So the quick assets, when we divide it by current liabilities, we get the quick ratio, and that quick ratio is useful in analyzing about the solvency of a company, and thereby we can come to know how fast a company can repay its short-term debts or short-term payments. And the health of the quick assets is literally helpful in knowing this particular kind of condition. And the second ratio, the second ratio mentioned here is asset turnover ratio. Asset turnover ratio is, so the second important ratio is asset turnover ratio. Here it is to, it is founded by the formula turnover divided by net tangible assets. Turnover divided by net tangible assets. So what is turnover? It is a total amount of sales you as a business person make over a period of time, say, for example, 1 year. And net tangible assets means total physical assets minus intangible assets and liabilities. So that is total net tangible asset. So turnover divided by net tangible asset is known as asset turnover ratio. So if the asset turnover ratio is found out in numbers, like if the number is higher, the less assets you need to make revenues. So that's a healthy position as far as business is concerned. The third one is working capital ratio. This is yet another important ratio we can get from the balance sheet. So this also is very helpful in understanding about the, or coming to know about the liquidity position of the, how a company is able to pay off its liabilities out of its current assets. So working capital ratio measures the capital used to finance the daily operations. So in order to finance a business daily operations, like meeting various expenses, etc., it needs finance. It needs capital. That capital is called working capital. So working capital position is very much significant from the point of understanding about the real health of its daily operations. So if daily operations cannot be uh, run properly due to the absence or deficit in the working capital, the running of the business will be a complex affair. So in order to find out the working capital ratio, we need to know how much current assets it does have and how much current liabilities it does have. So by uh, deducting subtracting current liabilities from the current assets, what is left is known as working capital. So that working capital is a better measure to know the liquidity position, and by knowing that position we are coming to an understanding that its daily operations can be run very in a safe manner. So here the two terms we have to understand is current assets and current liabilities. Is all we know that current assets means short-term assets that a company is expecting the user convert into cash within a short period of time. So that short period of time can be a fiscal period or accounting period of 1 year. Similarly, current liabilities are also short-term liabilities or obligations of the business that are to be settled within a fiscal or accounting period, say for example 1 year. And working capital ratio is the third important ratio mentioned here. And next we are going to know about inventory turnover ratio. So inventory turnover ratio is as it is written here, as it is mentioned here, it is a measure. How many months inventory do you have on your balance sheet? How many months of inventory do you have on your balance sheet? So it is founded by dividing cost of goods sold by average inventory. Two terms also are mentioned here, cost of goods sold. So cost of goods sold means it can be founded by adding beginning inventory with the purchase and minusing it by ending inventory. Opening inventory or opening stock or opening inventory plus purchases minus ending inventory or closing inventory. So that is cost of goods sold. Average inventory is beginning inventory plus ending inventory by number of months a number of period. So usually it is a number of days, a number of months, etc., etc. So that is the average inventory. So dividing cost of goods sold by average inventory, we come to know about the inventory turnover ratio. So that inventory turnover ratio is very useful in knowing about the inventory, how long it stays, how long it can be, how many months of inventory do we have. So that is inventory turnover ratio. This also can be found by analyzing two variables like cost of goods sold and average inventory. So cost of goods sold is found by beginning inventory plus purchases minus ending inventory. Beginning inventory means opening stock, ending inventory means closing stock. So opening stock plus purchases minus closing stock is cost of goods sold. In short, it can be said COGS, cost of goods sold. And average inventory is found by beginning inventory plus ending inventory. Opening stock plus closing stock divided by number of months. That is the time period. So thus we get the average inventory, and as a result we get the inventory turnover ratio. So that measures how many months of inventory we do have on our business. And the last but not the least is the cash conversion cycle. Cash conversion cycle is founded to check how many days we need to convert the cash out for inventory in cash. Formula is used here: days of inventory outstanding plus days sales outstanding minus days payable outstanding. It seems a bit complex. This formula seems a bit complex, but it is nothing but finding out the cash conversion cycle. Days of inventory outstanding. So how many days of inventory we do have, and the days sales outstanding minus days payable outstanding. So these are the 5 important ratios we can get from the balance sheet. I can repeat from the beginning. Quick ratio is the first one. Asset turnover ratio is the second one. Working capital ratio is the third one. Inventory turnover ratio. And the fifth one is cash conversion cycle. And this is all about this brief description about balance sheet analysis. Thank you for watching this video on balance sheet analysis, and I hope you all find it helpful and valuable in improving your understanding of financial analysis from the balance sheet. You can stay and tune for more such informative videos from Educare Coaching Academy. Once again, thanking you. Please like the video and also subscribe my channel. Goodbye till the next video.